Hi, so this video is an overview of how to connect discounted cash flow and the valuation of a share of stock. So I'm going to go through a sort of a logic model associated with this so that we can sort of understand generally what we're doing in this class. So the first place we start is we say we have a particular asset, and we actually want to know what the value of that asset is. We might want to sell it. We just might want to know what it is so that we can tell other people what our net worth is. So there's ways that we want to equate money and asset, put a dollar value on it. There's a couple ways to do that. We can look at other similar assets and how what they sell for. We can look at market prices. We can look at used eBay. We can look at someone who sells a similar product. We can look at the various supply and demand for this particular asset. If we look into the future, we can see that it's going to be in quite a bit of demand, so the price might be higher. So we understand from macroeconomics the relationship between supply and demand and price. So we might do some analysis on that. And another way we might do it is to say this particular asset has a payout over time associated with it. So we have this asset, and then over time we're going to get income or decreased costs from this particular asset. And actually it ends up that this method is one of the easier ways to do the calculations, because we can just do a forecast of what we think the payout over time is going to be and then determine that particular value. And the way that happens is using engineering economy. So if we remember in engineering economy, we have future cash flow from an investment over time, and we can equate that to a present value. And that present value is the amount that someone's willing to pay for that future cash flow. This is, and like I said, it's engineering economy. But one of the things we need to understand is what is the interest rate associated with this? Like, what is a comparable rate that we would use to do the present value calculation? So those are kind of some open questions. Now we're going to first look at so then the purchase price is equal to the present value. The value of it is equal to the present value. Now, if we have a lot of assets, like multiple assets, we can just sort of group them all together, and that could be the value of all of our assets. And lots of companies have many, many assets. They might have people, they might have patents, they might have money in the bank, they might have machinery, all of these things. And all of these things generate cash flow. So each of them has a particular cash flow. And if we add those all together, we can get the value of the company. So what we do is we look at historically from annual reports data, we can see what is the historical cash flow of a particular set of assets. It would be hard for us to value these in a different way because the annual reports are public information. So we look at this public information, look at historical cash flows, and then we use multiple regression to fit a model to the history. So we try to say, well, this is what causes this cash flow to go up and down. And then from there, we can use that to forecast into the future what the particular cash flow is going to be. Once we have that, we have the future cash flows from this investment based on the history of it. And so now we can do a calculation of the present value of these future cash flows. And then this becomes the value of the assets of the firm. So we've just gone through the logic associated with looking at assets. The value of assets is the present value of future cash flows. And we're going to apply that to a company that has many, many assets. And we look at the historical values in order to predict what the future is going to be. So what we have now is a set of assets, and these assets are owned by the owners of the company. And if you remember from accounting, the assets, every one of them is owned by the owners. And the various owners of a company are generally the debt or the equity owners. So debt are someone like the bank or a bondholders, somebody that you have promised to pay interest or to pay back the loan at a particular rate. The equity holders are those who actually own the company. And in a corporation, those equity holders are the people who own pieces of stock. So the equity of the firm is divided into multiple little pieces, and one share of stock is like one of these little pieces of equity. So you can see that actually this is we can calculate the value of this stock. we can say the stock price is equal to the assets minus the debt divided by the number of shares. So that's the stock price. And so actually it's not magical. It's a very solid calculation. And this is the basis for discounted cash flows associated with stock price. There's some issues that we're going to be working on in this. So this is a simple explanation, but we have a bunch of other issues. So one of them is, how do we retrieve the correct financial data? Historical earnings by business unit, interest, debt, number of shares. We have to gather all of that. We have to be careful of that. We also have to develop a forecasting model, which is not simple in itself. We also have to decide on a discount rate or an interest rate. And we have to decide on how many periods into the future we're going to be forecasting. There also might be some potential new business units that aren't in historical earnings, so we might need to account for that. For instance, a firm like Tesla has negative historical earnings, but they have a lot of potential. So how do we incorporate that potential in there? And then there's going to be other issues as we go along. Now, hopefully this has given you an idea of the model that we're going to be using for discounted cash flow model for stock valuation.